Hello and welcome to today's Insider video. I've got a very special guest joining me. Kind of been the subject of my essays all week. It's the one and only Tom Meyer. Tom, how you doing?
Hi, Woody. How are you?
Yeah, I'm good, thanks, mate. I'm good, thanks. Yeah, I'm really glad that I must admit, I called you last minute to try and get you on, and you dropped the basketball game, and here we are, which is great. So I've been writing a lot about trend following this week. It all stemmed from the awesome story of Richard Dennis, the famous trader that put an ad out to the Wall Street Journal, and he took in 12 traders that they may have been amateur investors, but it involved a a board game designer, a tractor driver, and but he managed to turn them using a proprietary system which fundamentally used trend following to trade the markets. And three of those people are actually still billionaire fund managers today, I believe. Anyway, so you are our resident trend expert, so I thought I'd get you on and we could have a bit of a chat about it. But first and foremost, I figured there'll be many readers of the Insider that don't actually may not know who you are. So perhaps we could just start from the beginning, really, and tell us your story, Tom. Like what's your expertise? What brought you to designing algos to identify trends in stocks, and what brought you here today?
Woody, thank you. I've been in the financial services business for 28 years now. I started in 1993 with a firm called Dean Witter, an old line, smaller retail brokerage firm in the United States, headquartered in San Francisco. They merged in 1997 with Morgan Stanley. I was an assistant manager and then a manager within the system. So my background is definitely the traditional financial services, traditional brokerage firm, traditional Wall Street. And the first bear market that I participated in was terrible for my business, but it was also a period of time when the light bulb really went off. Now, in our business, we think that there's a lot of inside information that you need to know. An outsider thinks, oh man, that Tom is with Morgan Stanley. He's got to have a bunch of inside information. And no, no, most of the financial professionals, most of the so called money managers, Woody, they're not money managers, they're salesmen. That's
Mm.
all they do is they gather assets and then the firm manages those assets. And that's the way that the 1990s and the early 2000s rolled around, and that's what was happening. It went away from the stockbroker actually making picks to the company themselves managing for the so-called money managers. Well, the first bear market comes around, and the markets are dropping. They're ugly as can be. The dot com was all crashing, and we had no guidance from our firm as to how to get out of our positions, how to protect our clients' monies. Essentially, we were told, and we were told to pass it on, oh, don't worry, the market's going to come back. Well, that sounds great until you realize there are a lot of individual stocks that go out of business,
Mhm.
and individual investors tend to be emotional. The secret is professional investors tend to be emotional too, but they'll never admit it. And uh, people get scared, they get nervous. You go to sleep and you wake up, and the next day you're down another 2 or 3%. And the next day maybe it goes up 1%. And you're thinking, "Phew, maybe this is over." And then another 2% drop or another 5% drop. And it goes on and on and on. And it's not unusual during bear markets to lose 50% or more. And our clients at Morgan Stanley were hung out to dry. None of the analysts told us to sell the stocks. And what was really happening behind the scenes was the institutional side of Morgan Stanley and all the big brokerage firms have working relationships with the individual companies. They they do stock offerings or they'll do bond offerings, and they'll make way more off of those offerings than they will off of the commissions from retail traders. So they don't want to put a sell rating on one of the companies that they're doing institutional business with.
Mm.
The company will go to a competitor. So essentially, individual investors are left they're left hung out to dry, as we say here. And it was at that period of time that I realized selling is more important than buying. And it's kind of counterintuitive, isn't it? Because everything that you hear and most everything that you read in the financial news media is telling you how to buy. And this stock has great fundamentals, or this stock has bad fundamentals, and this stock has great technicals. And people are spending 90, 95%, maybe 99% of their time trying to figure out what to buy. And then once they buy it, they have no clue how they're going to get out.
Mm.
What's your exit strategy? If
Mm.
you were to ask any of most any individual investors that just bought a stock, ask them, when are you going to get out? And usually you'll get like this dull look on the face. They don't know.
Mm.
And yet, selling is more important than buying. I suggest to you that you can make money with almost any stock if you know how to get out of that stock correctly. So after a bitter disappointment for myself, for my clients in the early 2000s, I was fortunate enough to come across a gentleman who was at the forefront of creating algorithmic investing software. And we met, we were introduced, we met, talked. We were going to go to lunch for about an hour, and that hour ended up being 3 hours. And what was amazing is that I realized that here's someone who understood how to sell, and that is the single most important element in managing your portfolio. If nobody watches the rest of this video, Woody, and the only thing that they take away is that selling is more important and you have to have an exit strategy before you enter a stock, this will be a very successful video for those who are listening. But hopefully they'll listen a little bit longer. The uh the more that I got into algorithmic investing and understanding it, the more the light went on for me, and I started doing research, and I heard about the turtle traders and read a lot of information about trend followers and how trend followers might not make the most money in one trade or in two trades, but over a long period of time they set themselves up to make more money than people who aren't trend
I was going
following.
to say one of the things I covered in the essays this week was that there was a study done of the top funds over the last number of decades, and out of the top 20, the biggest majority of them by far were trend following funds that outperformed other selectors over the longer term.
And that's the key, is over the longer term. If you want to ask me, am I going to guarantee the next trade that we make? I guarantee we have the entry signals, and I guarantee you we know what our exit is. It doesn't mean that it'll necessarily be positive. But if you say to me, Tom, I'm going to close my eyes for 5 years and come back, I'm going to tell you that you've got a really, really, really high probability of being successful following trends and understanding trends, understanding what they can do for you, understanding when you have to get out of them.
Mm.
So trend following acts as not only a strategy with defined entries and defined exits. Now, the defined entries and defined exits can change every week. And you're quite aware of that because you see the work that we do in Algo Trend Trader, and the especially when we're in a trade, the stop loss changes every week. And that's an important element because we need to know when to exit the trade.
Mm.
So uh, we might not know the exact numbers, but we know our exact entry based on the signals, and we know our exact exit based on the signals. So not only do we have a system that tells us when to buy and when to sell, The system acts as a discipline that forces us to invest in, it forces us to act in our own best
Mm.
interests. It forces us to get out of a trade with a small loss and not turn a small loss into a large loss. And it allows us to get out of a winning trade with with as much profit as we possibly can, given what the trends are. Now,
I
when the
was gonna say
system,
it gives you the, I guess, another big um, benefit or advantage of it is that it gives you that confidence that you're in a trend, and you can go to sort of bed and to know that you're not having to make those daily decisions yourself or based
I
on
think
emotion. But just one, I've got one question, Tom, before we go on. I know you prepared a few slides. Um, I mean, trend following is almost, I describe it as an intellectual village of, there's loads of different trend following experts, traders, and people do it. Um, but you made a good point a couple of months ago when we were talking about this. So we used the Richard Dennis as an example of, he taught a set people his proprietary method for trend following. There's actually millions of different ways you can identify trends, we correct, but I guess the key thing is consistency. Like, you don't switch and swap. It's like you find a system or a strategy of identifying a trend, and it's up to you then to keep consistent with it.
there's nothing wrong with taking the algorithms and the mathematical formulas that you have and trying to make them better. Every trend trader has a set of rules, and they're constantly trying to make those rules better. We saw a year ago the the value of working to make the rules better, and that's when we came up with our overbought and our oversold rules. Our oversold rules came into play after that swift downturn last March. We're going to show that on the ASX 200 here in a moment. But
Mm.
because our oversold rules kicked in, we were able to get out with a really nice profit,
So
as
just
opposed to just waiting for the normal signal.
So also what the oversold and overbought. I mean, just to explain that the technical description of it is, I guess that you could have a signal that is, well, it's clearly in a downtrend, but if it's in the oversold area, you know that there's probably a high probability of that trend breaking relatively soon. So you might want to just hold off, and wait. Is that a good
Well,
summation?
when we're looking at oversold or overbought, indices and stocks tend to stay within normal ranges up or ranges down. But when they get to what we have identified as overbought and oversold, there's a high likelihood that there's going to be a snapback to the norm.
Gotcha.
And we don't want to leave a lot of profit on the table when that happens. I'm going to tell you something that most trend followers won't tell you. Trend following works really well, except in two conditions. And the first condition is when the markets are relatively flat. No trend, up a little bit, down a little bit, up a little bit, down a little bit, up a little bit, down a little bit. If there's no trend, we're not going to guess, and we'll just stay on the sidelines and be in cash. Also, most people think that risk is highest when the market's moving lower. We believe that the risk is highest when there's no trend, because why would we put our money to work and risk losing
Mm.
whatever percentage if there's not wind behind our sails, not wind behind our back to uh, uh, that works in our favor. So we don't really care if the markets or the stock is moving higher or moving lower. It will do both.
Mm.
Over time, it will do both. We just want to identify, when does that particular stock or index have momentum. We want to jump in when the momentum is on our side, let it run as far as possible, get out whenever that trend ends. It could be a month or so. We're probably going to lose a little bit that way. It could be 6, 8, 10 months, and we're going to make a ton of money. So we don't know when that's going to happen. It's just like those guys riding the surf. So the surfers, they don't know if it's going to be a great wave or not. They get on, they catch a wave, and sometimes it just peters out really quickly, and then sometimes it's the ride of their life. And uh, that's what we're looking for. We're looking for good, solid trends that'll last at least a few months. The markets trade in trends. Now,
Mm.
the second condition that we don't do as well in is markets that have very quick V-shaped moves to the upside, to the downside, back to the upside, because there's not a lot of time to develop the trend. That's why the overbought and oversold rules. So we don't lose if we're in a trend and we're making money. We don't want to lose a lot of the profit because of a sudden jerk or a sudden V-shaped move in the market.
I see.
And otherwise, trend following has worked. There's no reason to believe that it won't continue to work. I know that you have mentioned in the past some studies. There's a Robeco group, which is a group in the Netherlands that actually went back to 1800, and they looked at stocks, they looked at indices, they looked at currencies, they looked at bonds, they looked at commodities, and in each of those categories, trend following gave the best return over that 200-year period of time.
Mm. Yeah, we actually feature that in the presentation I made. Yeah. Hmm. I think it went
It's
back
something that
137 years, I believe, of data.
that's yeah, right. There are a number of the studies like that, and trend trading tends to come to the forefront. I don't want people to think that this is magic. It's not. It's math. I don't want people to think that every trade is going to be a winning trade. That's not what happens. In our world, if we can get 56, 57% winning trades, we're really happy. But here's the key: the winning trades are going to outperform the losing trades by 50% or 75% or 100% or more. And that's what we're looking for. We protect our downside. We're willing to take small losses to get into a trade, and we're willing to ride that trend for as long as it'll let us. And our results have been really good, and there's no reason to expect that they won't continue to be good over the next several years.
Mm. Now, you prepared some slides, Tom, just to
I
show
did.
trend following in action. Do you want to talk us through those?
Now, do you remember last year and the stock market dropped so quickly?
Yep.
Right before that, in the first part of 2020, we had a long trade, a bullish trade in the ASX 200, and it stopped out the week before the big downturn. And that, of course, turned into a bearish signal. And after that swift decline in the month of March, really the first 3 weeks of March in 2020, because the downturn was so swift and so steep, our oversold rules kicked in. And once that happened, we told our members and we told our readers how to manage that and how to change their stop loss setting. And we used our oversold rules, and we collected a profit in after essentially 3.5 weeks. We collected a profit on the downturn of more than 25%. And here's the chart on that on the next slide. So there's our chart on the ASX 200. You can see that it triggered a bearish trend on the 2nd of March at 64.38. And then just a few weeks later, our oversold rule hits, and we exited the short on the 25th of March using a trailing stop of 48.02. So we gained uh gosh uh 1,600 points
Mm.
in just 3 weeks.
And
And it's
it's all about
because we were able.
using that yellow channel, right? So if the trend dips below the bottom line of the yellow channel, that triggers the the the, the downtrend call, doesn't it?
That's correct. I don't want to get into too much detail on this. The rules that we have in place are, I think that we mentioned that yesterday
Yep.
in the Insider. So maybe our readers can go back to yesterday and read how we determined bullish signals and bearish signals. But it is all predicated on that yellow channel. By the
Yep.
way, Woody, you notice that the very far left hand side in 2018, the yellow channel was pretty narrow, and then it increased a little bit, decreased a little bit, and then of course in 2020 it increased dramatically.
Mm.
And we're just now, if you look at the very tail end of that yellow channel, you'll see it's beginning to compress again. It's beginning to contract. That means volatility is dropping. When the channel widens, volatility is increasing. When the channel contracts, volatility is decreasing.
Mm.
Decreasing. We measure that every week. We share it with our members every week. Volatility is dynamic. It is not static, and so it's important that our members know, because we use the volatility of each underlying ticker that we look at. We use its underlying volatility and the uh, to determine our exit strategy.
Yep.
So that's gold is one of the ones. You and I have been talking about gold for 2 years now. We have in the Big Ten for Algo Trend Trader, we have the gold ETF. GOLD is the ticker symbol on the ASX. That is the ETF for physical gold. We've identified strong bullish trends in the 2 years that we've been following it. But we all know, looking back, that August was the high, but nobody knew in September that we were going to hit a bearish trend. Our signals told us to get out of gold in September. I think most analysts were saying that the top in gold was still going to move higher. We got out, we collected our profit, and we actually began to invest in bearish trends in gold before the end of 2020 and even through today. You can
Mm.
see the chart on that coming up. So you can see that's just beautiful, isn't it? You can see that the times that the black line had overlaid with the green line there, that it was bullish, and there were times that we were able to get on. We had a couple of very nice trades, and one trade I think gained 15.5%, another gained close to 16%. We got out in September and we started getting into bearish trades in December. Now you'll notice towards the end of the year, it had a pop up higher. We lost a couple of percent in that, a little further to the right,
Mhm.
and that's
Yeah.
the bearish trade we lost in. But then look at that, the bearish trade took back hold again, and we're sitting in a profitable position even if we stop out. So gold actually got into a an oversold condition, and we're using a trailing stop on that right now. So we've guaranteed ourselves a profit on the bearish trade in gold, and it certainly could continue to move lower. Nobody knows. We're
Mhm.
not trying to guess what's going to happen with our system. We're just measuring what has happened. We're measuring the trends, and then at some point in time, the trend will end. But nobody knows when that's going to happen. That's why we have our stop losses in place, and we wait for another trend to develop. Again, it doesn't matter if it's bullish or if it's bearish. We just want to invest in a trend that has momentum.
And the one thing about your showing here also that it doesn't really matter what the market or the stock is, right? So I think currencies is next. Like
Currencies,
even though they
exactly. So the same trend following algorithms work for currency trading. They also work for bond trading. A little bit later, we're going to look at cryptocurrency. Now, for most of the second half of 2020, the Aussie dollar was moving higher against the US dollar. And if you go to the next page, you'll see that the uptrend lasted for a while. You had a good uptrend from the middle for a few months, and then another good uptrend that lasted until right into January. But you can see now that the Aussie dollar has lost some of its strength, and it's inside that yellow channel in a neutral condition. And this is one that I don't know if we should give this away, Woody. About once every month or once every 6 weeks, we actually share with all of our Algo Trend Trader members a some charts on the cryptocurrencies, on larger cryptocurrencies. Ethereum gave us a bullish signal on the 25th of May at $220. Now that's US dollars.
Mhm.
$220 was our entry signal. We have for everything that we measure, an index, a stock, we have what's called an expected move, and that's normal weekly volatility. Right now, with that move higher in Ethereum, our weekly volatility stands at $610. In other words, if you were to buy it today at 2400, you've got to assume that it could go down to 1800 and still be in the uptrend.
Mhm.
Now, our current stop loss based on the algorithms is at 1411. For those wanting to take a little bit less risk, uh, you use one expected move as a trailing stop. That would work out to about 1842. Ethereum tonight, Woody was trading at $2,400. That's one heck of a return from the 25th of May at
Yeah.
220.
But I guess we showed this with, here's the chart for Ethereum. Look, there you go.
It's an amazing chart. But take a look at the end of 2018. Look at how we could have made money on the downside.
Yeah.
That was an incredible trend. And then we were essentially in no trend for about really for about a year. We had a couple of times that it nudged above the yellow, a couple times it nudged down below, but there was really no trend until we got that bullish signal on the 25th of May, and it's just been
And what's notable,
climbing
look at the widening volatility there, look, on the side.
crazy, isn't it? Well, you figure 600, 600 and some
Yeah.
odd dollars of is the expected move, and at $2,400, that's 25% normal volatility.
Mm.
Normal volatility.
Well,
People
I
who
guess
get into it,
that's the kind of uh, what I alluded to earlier with the confidence, what a system, a trend following system that measures volatility gives you. You know, you kind of know what to expect. So you know, if you're invested in Ethereum or whatever, and it goes down 10%, you know, you don't necessarily need to worry too much because it's what's expected to happen.
absolutely, it's normal volatility. Absolutely. So we're going to give that to our members once every 4 weeks, once every 6 weeks on Bitcoin, Ethereum, and a few others of the larger names. So ultimately, why should people consider trend following? Well, Woody, it works. There's a lot of historical evidence, and the the members of Algo Trade Trender who have been uh, who have been following us since May of 2019. They've got a lot more winning trades than losing trades, and they've certainly had the opportunity to cash in on some really nice trades. Again, not every trade is a winner, but the winning trades outperform the losing trades over a long period of time.
Mm.
Why else consider it? Because you know the exact entry points, and most importantly, you know when to exit a trade. That is, I can't repeat that enough. Knowing how to sell is the single most important element in being a successful investor. And then with trend following, there's a built in discipline that forces you to act in your own best interest.
Yeah, that kind of brings us nicely back to where we started, really, about knowing when to sell. That's the key thing, and that's what that's the real advantage, I guess, isn't it?
It totally is. Everybody who is an investor, everybody who is a successful investor in the markets has an exit strategy. And if those listening today don't have an exit strategy, take some time soon to determine what your strategy is. You make the rules for the trading and let your rules do the trading. If you want to change your rules, you can. That's all right. A lot of us change our rules. We're always trying to fine tune what our rules are, especially on exits and entries, but especially exits.
Mm.
And if you don't have an exit strategy, start taking some time and learn how to do it.
Well, I think that's a great place to end. Thanks, Tom. It's been, I know it was very short notice for you, just so that everyone at home knows, he had his feet up watching the basketball. And I said, Tom, let's do a video. And he said, sure.
I think for the basketball fans out there, they need to know that the San Antonio Spurs are my favorite team in the NBA, and Patty Mills is a gem. What a hell of a player, but an even better man. He represents he represents Australia quite nicely.
Nice. All right. Thank you, Tom. I won't keep any more of your time, but thanks so much for sharing those insights. Much appreciated. And it was a really fascinating conversation.
Thank you, Woody. Have a good weekend.
Cheers. And you.